Lynn is recording this committee meeting. This is the committee meeting, the Other Post-Employment Benefits Trust Fund Investment Committee. And today we have a new member on our committee. Mr. Dean Rose is our representative for our Board of Education. Dean, welcome.
Thank you very much. Glad to be here, and thank you to everyone who's serving on this committee. We appreciate all your hard work.
No problem. And I'm going to ask the folks to go around and introduce themselves real quick so you know who they are and what group they're representing being on the committee. So, Shirley, I'm going to start with you because you're in the top left of my corner.
Okay, I'm Shirley McDonald. I'm representing community at large and retired teachers in particular.
Great. Alton?
I'm Alton Fryer. I'm the investment consultant to the committee.
All right. Derek?
Derek Huber-Beat, assistant principal at Monocacy Middle School, but I represent FACASA and I'm their vice president of FACASA.
All right. And Rob?
I'm Rob Bruno. I'm a personnel officer in human resources who hires certificated staff, and I'm representing human resources.
And Renee?
Hi, I'm Renee Milburn. I'm the restricted fund accountant and I represent the AMT group.
All righty. And George, I believe you're online.
Yes, I'm George Labasco. I'm a volunteer with the committee.
And Brian.
Good morning. I'm Brian Ropp. I represent the community at large and I'm on my second term.
And I have a D and an L buttons, but I'm not sure who that is. So if you haven't introduced yourself, if you can unmute.
Lynn McKay, I'm the recording secretary.
Sorry about that, Lynn. You're the L.
Oh, that's okay.
I think we have Tony.
Tony is not present.
Oh, okay. I thought I saw her picture come up. Okay.
Yeah.
All righty. And so, Dean, just for your reference, we do have 2 committee members on our team, which has been very, very helpful. That was something that when we diverged from the county and created our own investment committee, that was something the board wanted to have, was representation on our committee of not only folks within FCPS, but folks outside that had expertise in investment. And that's where Brian and George come in, and they have been serving very well in their capacities for us and had helped us through our most recent RFP process too. So it's been very nice to have community members on the group. So with that, I just have to read a closed session announcement before we get into some business. In accordance with Maryland's Open Meetings Act, General Provisions Article 3-305B-14, the Other Post-Employment Benefits Trust Fund Investment Committee met in closed session at 9 a.m. on November 18th, 2022 via Google Meet to discuss a matter directly related to a negotiating strategy or the contents of a bid or proposal because public discussion or disclosure would adversely impact the ability of the public body to participate in a competitive bidding or proposal process. We're also going to go into closed session later in this meeting today, just simply to approve the minutes from that November 18th meeting. We also have next on the agenda the approval of the open meeting of November 18th. So has everyone had the opportunity to read the minutes from the November 18th meeting? And if so, do I have a motion for approval?
Hi, Leslie. I'll motion to approve the minutes from November 18th.
Thank you, Brian. And a second?
I second.
Derek seconds. All those in favor say aye or raise your hand.
Aye.
Aye.
Any opposed? All righty. Well, they're approved unanimously. Thank you, guys. All righty. Well, we're going to turn this over to Alton. He's going to go over the financial performance review for the quarter ended December 31st, 2022.
Thank you very much, Leslie. And I'm bringing up my screen, which has the report. as of December 31st. And as always, if you have any questions as we go through, please feel free to ask. There'll also certainly be time at the end of our conversation today to talk about this. Again, this report's as of December 31st. And I always say that because during the past several years, it turns out that in the 6 weeks or 8 weeks between the end of the quarter and whenever we meet, the markets don't seem to want to behave and just move consistently in one direction or another. So I do also have an updated set of values for the assets that I'll share when I'm done with the presentation. So as we move through the report, as we've done in the past, the first section of our report covers the economy and the markets as they were in the fourth quarter. And the idea there is to provide the committee with some background for the investment results and the individual results of the trust itself. And I'm happy to report that for the fourth quarter, we finally had some positive results, at least on the market side. The question from an economic standpoint has not really changed all that much, though. The inflation is still the headline story. It's still what we hear about the most. And as we were discussing before the meeting, one of the Fed's preferred measures of inflation actually came out as we were starting this meeting. I haven't had a chance to look and see if that news was good or bad. But nonetheless, inflation is the biggest concern. And as a result, how the Fed chooses to fight inflation is what's really having the biggest impact on the markets. As you've continued to see and hear, the Federal Reserve has been raising interest rates pretty consistently since the beginning of last year in an effort to reduce demand, to slow down the economy, both on the personal side as well as the business side of things, in an effort to bring demand in line with supply and thereby stabilize prices. The other side of that is the supply chain, which, as we all know, a year ago was very much bound up. It was difficult to get chips for anything, and shipping internationally was not looking good. As you can see on the third, yes, on the third bullet point in this page, not only have gas prices come down, but international shipping costs have come down, reflecting a loosening in that global supply chain. Several of the measures that the Federal Reserve looks at, the Global Supply Chain Pressure Index is down 70%, shipping costs are down 80% from their peaks in late 2021. And as with any sort of free market, as prices come down, that tends to indicate that there's plenty of supply to meet the demand that's out there. And so as the supply chain loosens up and there's more supply available, and as demand comes down as a result of interest rate increases over the last year or so, the expectation is that we're going to see prices stabilize more in 2023, and we'll start to see that rate of inflation, which is measured year over year, start to come back down towards the level that the Fed targets. The Fed has long targeted a 2% rate of inflation as its goal, and that's been explicitly stated. And so as a result, even though we've come down on most inflation measures from the 9.1% high we saw in June of last year, we're still seeing inflation in the 5, 6, sometimes 7% range, which is still well above the Fed's target. And that's why you continue to hear, even though inflation is slowing, you continue to hear that the Fed will continue to raise rates into maybe the middle of this year or later. It's also why when we get poor economic data, you see the stock market go up. The idea there is if employment is softer, if GDP is slower or growing at a slower rate or softer, then it would be less likely that the Fed would continue to raise rates, and the markets think that's a good thing, so the markets take off a little bit. It's kind of counterintuitive that the economy slowing down or things looking more recessionary would be good for the markets. But in this case, the number one thing the markets care about is that continuing increase in the Fed funds rate. So you'll see some of that this year, probably, where we just saw it a few weeks ago. The employment numbers came in much, much stronger than expected. I think we saw 500,000 jobs added when 200,000 were expected. And the stock market hated that idea. And they hated that idea because it meant that the Fed was likely to continue raising rates into the foreseeable future. Now, you may say, okay, the Fed's trying to execute this soft landing that we've heard about. Maybe they should stop raising rates. But if there's one thing the Fed learned from the last time we saw inflation, which was 40 years ago or so, it's that inflation really needs to be killed off completely before you can start worrying about the economy. And inflation is insidious in the negative impact that it has on the economy, and persistent inflation becomes increasingly harder and harder to fight. So kill off inflation first, then deal with the results of that, which may or may not be a mild recession. And fortunately, the way the Fed fights recessions is by cutting rates, and now they have a little bit more ammunition in that regard after what we've seen over the last year or so. So that's sort of the economic story that we're seeing right now. The expectation is the Fed will continue to raise rates, albeit probably not at the same pace that they did in 2022. We'll probably see some softening in the economy, potentially a mild recession towards the end of the year, but it's laying the groundwork for a longer and more positive growth in the economy once we get through this inflationary cycle. In the fourth quarter of last year, we finally saw some positive returns in the markets, and I've been saying all of last year on this chart, the zero has been the top line for this chart for the last 3 quarters. All of the bars have headed down from that number, whether we're looking at quarterly returns or annual returns or year-to-date returns. This is the first quarter since the fourth quarter of 2021 that we've been able to report that there's been some positive moves in the markets. And it was fairly universal. U.S. bonds were really the only area that was flat. All other asset classes that we show here on this report had positive returns during the fourth quarter, but not enough to reverse the trend from the year. The orange bars represent the year-to-date or the full calendar year of 2022. But we did see value stocks continue to do well, growth stocks not as well. Largely driven by technology stocks, Tesla, Amazon, Apple, and Google were among detractors during this period. But overall, this is a positive for the fund, and we've seen the value of the fund increase from the third quarter to the fourth quarter. We have this page that looks at the drivers of capital market returns. And the idea here is to capture some of the measures that are most important to either bond investors who are lenders or equity investors who are owners. And I've talked about much of this already in my comments today, but the one I would point out is the credit spreads in the right-hand side on the return to lenders. We've seen credit spreads, which is the measure of the yield spread between a to BBB minus rated corporate bond compared to its corresponding U.S. Treasury. And when you see credit spreads narrow, that generally reflects a more positive view of the economy going forward. It means that investors require less of a difference between the U.S. Treasury yield and corporate yields in order to invest in corporate bonds and take on that little bit of added risk that comes with giving money to an entity that is not the government. When we see credit spreads expand, that generally means that investors are moving towards safety, they're moving towards treasuries, reflecting a more pessimistic outlook going forward. So the fact that credit spreads have contracted in the fourth quarter is certainly a positive in terms of the long-term outlook in the fixed income markets and for the economy in general. The best performing asset classes we've talked about was large cap value. Value stocks generally did the best in 2022. And although they were negative, they were not as negative as the other asset classes that we look at here. And fixed income had probably the worst year we've seen in fixed income in anybody's memory. Core bonds were down 13% for the year, but they were still the third best performing asset class. So while we had a terrible year for fixed income, equities for the most part were even worse, although equities were more in line with their historical norms for a negative year than bonds were. But nonetheless, there really wasn't any real safe port in the storm when it came to public assets in 2022. And that's why we've seen across the board, our clients have seen the value of their accounts decline as the markets have almost universally moved in a negative direction. Nevertheless, if we look out 10 years ending December 31st, the S&P 500 still averaged almost 12.5, almost 13% return over the last 10 years. So despite the fact that we saw a negative 18% return for 2022 in the S&P 500, the average return over the long run was still very good. The U.S. aggregate, which is the bond index, does not have quite the same story. The long-term return is about 1% per year on average over the last 10 years. And that's almost entirely due to how poorly this year went. Although the fact that we've been in a low interest rate environment for the last decade or so means that there's been almost no coupon or yield in the fixed income space either. And so as a result, we see those long-term returns that have been somewhat negative. Now, that being said, the fact that rates have come up means that if you're buying bonds now, you're actually getting some coupon, you're getting some kind of return. And if you're buying a 10-year treasury that's going to pay you several percent per year, then that's going to hold up better over the long run, although we've seen the disruption to the issues that were held prior to this interest rate increase and the increase in the yield curve. So all in all, the long-term story is not quite as bad as the short-term story looks. And for the fourth quarter, we saw the value of the trust go up from 139 million to almost 149 million. So just under a $10 million increase in value during the fourth quarter of 2022. The return was 6.69%, which is in line with the policy benchmark. And overall asset allocation detracted from performance. We were a little bit overweight to fixed income during the quarter, and much of the positive returns were on the equity side. But the fixed income managers that we have actually had a very good quarter. So while the allocation to fixed income was a negative, Dodge & Cox outperformed the index by 89 basis points. Western Asset, which is on our watch list due to their performance, recovered very nicely and outperformed the same benchmark by 137 basis points during the quarter. So we talked a lot about Western Asset at the last meeting. We reflected that we want to continue to keep an eye on them. This one quarter of positive performance does not mean they're off the watch list. It doesn't mean that we're going to stop calling the manager and asking them questions and seeking to understand what's going on. But I have to say, we're not surprised that Western Asset bounced back a little bit. This is a manager that over the last 10 years has been outstanding and just was exceptionally poorly positioned for how quickly the Fed pivoted at the beginning of the year to a policy of raising rates. and Western Asset was hurt more so than Dodge and Cox was by that change. But this is part of the reason why we have Dodge and Cox paired with Western Asset, because they do two different things in the fixed income space, and as a pairing, they work very, very well together. And over the long run, have typically beaten the U.S. aggregate index and beaten it pretty handily. For the calendar year, the numbers are not quite as good. We were down 17.16% for the calendar year, which was in line with what we would expect. We trailed the benchmark just slightly, but that had a lot to do with the fact that in 2021, equities were very strong, and we entered the year overweight to equities, which was the primary driver of that underperformance. In other words, had we entered the year perfectly on balance with our target, then our returns would have been in line with the policy benchmark, rather than being about 19 basis points or about 0.5% below that benchmark. The asset allocations are well within the target range, and no rebalancing is recommended, especially when, I mentioned in the last comment that being overweight to equities was the primary driver. Let's keep in mind that the underperformance was 0.1%. So trying to rebalance every quarter or all the time to try to avoid that slight trail in performance is not really a prudent way of going about things. And I know my comments might lead you to think, oh, well, why don't we rebalance every quarter? And the reason is that sometimes that works in our favor, and over the long run, it tends to wash out. So as I mentioned, Western Asset remains on the watch list. Should their performance continue to be positive going forward, we expect that sometime in the next 6 to 12 months, we would remove Western Asset from the watch list, provided that there's no other changes that occur, whether that's a change in strategy, portfolio manager, or something like that. It was placed on the watch list for performance reasons. Consistent performance or outperformance is going to be the reason it comes off the watch list. We have no reason to expect that they would not come off the watch list, and we're not expecting to change that manager in the near future. Any questions about that?
No, just glad to see that their performance is back up.
Yeah, absolutely. So I had mentioned we're more or less in balance, and the asset allocation page that I have here on the screen shows that that's the case. While we're slightly underweight to domestic equity right now, international equity is a little bit overweight. So all told in equities, we're about 1.5% underweight. We're about 1.5% overweight to fixed income. These are all, as I mentioned, well within the ranges allowed in the policy. And as of right now, there's no real reason to rebalance the portfolio. It should be noted that whenever contributions are made, we're always going to make those contributions to the most underweight asset, and that tends to keep this portfolio in line with its target allocation.
And I think we had a deposit in February, correct? And we put that in fixed income?
Yeah, I think we had swayed to being underweight fixed income because the markets were so good in January.
Right.
And that's part of the reason why, we're not going to try to time the markets with this rebalancing when we're only out of balance by 1% or 2%. If we approach those bounds, that's when we would look to do a rebalancing. Otherwise, we're going to do that through those contributions.
And just for the committee's information, that was the last deposit for this fiscal year. We do not have another deposit until the beginning of next year. That's all going to be budget dependent on what's in the final budget for OPEB for next year.
Hey, Alton, if I could ask one quick question. So on slide 5, you kind of highlight the returns of the public markets.
Correct.
How did the private markets do, and should that potentially accelerate our view of maybe adding the more private assets to the portfolio?
Yeah, so that's a good question. We talk about the assets as being the public assets, and this portfolio is entirely invested in public mutual fund assets. There's a whole other world of private assets that are out there that includes private equity, private real estate, infrastructure investments, and a whole host of other things. Private real estate funds, which is one of the areas that we've at least brought up in the past, their returns for last year were actually, they were decent, and most funds that had some exposure to private real estate experienced an annualized return or an annual return in 22 that was better than what we saw in the OPEB. That being said, we've had numerous conversations with those private asset managers, and they are expecting 2023 is not going to be a very good year for them. There tends to be a little bit of a lag in performance in private assets because they're not valued on a daily basis and they're not as liquid as public assets are. So as the real estate markets adjust to the interest rate environment that we're in, we're seeing the values of properties come down a little bit. We're seeing less liquidity in the real estate market. And many of those real estate funds are expecting outflows in 2023 and are expecting to see some write-downs on their values in 2023. So while those markets did better in 22, a significant part of that was due to this sort of the illiquidity of the asset class and the fact that the valuations tend to be delayed a little bit because you don't know how much the private asset is worth until you try to sell it. And that's kind of where they're at now is people are asking for their money back. They're moving out of some of those assets because they're expecting those downturns this year. The private real estate managers we've spoken with, they're not expecting to call much capital in 2023. Meaning that they are not expecting to put money to work in private investments as much in 2023, and they expect to start calling capital again later this year or into early 2024. And what that means is when private investors call capital, that means they're going to take money from the people who've committed to them, and they're going to start to put it to work, whether that's in an infrastructure investment, a real estate investment, or by investing in a private company. So Brian, does that answer your question?
Yep, very helpful. Thank you.
Sorry, I digressed a little bit, but I felt it was important to understand the context of, yes, they would have helped in 2022, but they're probably going to be a net detractor in 2023. So any other questions? There's other information in the report. We can talk about individual managers if you'd like, but I know that you do have some other business to attend to today, and the meeting is only scheduled for an hour, and I don't want to take up more than my fair share of that. So if there are no questions, I'll click over here and share the asset values as of February 22nd. And we're at 155 million, which is up from December 31st. It's down a little bit from January 31st. I think we're at 158 million or so at that point, which is just reflecting what's happened in the markets over the last several weeks. But nonetheless, you can see here where we've seen a little bit of that movement. Fixed income is slightly overweight now due to the pullback in equities over the last several weeks, but we're almost right on target for all of the asset classes. And I'm happy to report we're back across that 150 million threshold, which is really nice to see. And hopefully this year we'll see the markets move in a more positive direction, and we'll move back up to top that high that we saw in 2021.
And I'm with you, Alton. I was glad to see it over the 150,000 mark again, 150 million mark again, and hopefully, like you said, get back up into the 170s or something. I think we topped out at one point, so that's good.
Yep. Yeah, certainly moving that way.
Any questions for Alton on the quarterly evaluation or the current asset allocation update that he presented here? All righty. All righty. Well, great. Thank you so much, Alton. Glad to see the quarter was a positive one. All right, we're going to now move into closed session. So in accordance with Maryland's Open Meetings Act, General Provisions, Article 3-305B, the other Post-Employment Benefit Trust Fund Investment Committee will meet in closed session today to approve the November 18th, 2022 closed session minutes. Do I have a motion to go into closed?
I motion to go into closed session.
All right, Derek, a motion, second.
I'll second.
Is that Shirley or
Renee.
Renee? Thank you, Renee. Renee seconded. All those in favor, say aye.
Aye.
Raise your hand.
Aye.
Perfect. Any opposed? All righty. Well, Alton, we're going to kick you off. We've got to approve some minutes.
All right. Well, thank you very much. It's good to see everybody. I hope you got out and enjoyed the weather yesterday. It doesn't look like it's going to continue, but it's good to see everybody and have a good weekend.
You too. Thank you. Bye.
All right. Bye-bye.